When we talk about the massive artificial intelligence boom, your mind probably jumps straight to cutting-edge algorithms, right? Or maybe the sophisticated software, or the famous household names actually designing the chips. But who is the giant quietly powering the physical revolution underneath it all? Like, who is actually plugging in the gigawatts of power required to make this entire new world function?
$18.2 billion. Let that number just sink in for a second. That is the potential value of just one single massive lease agreement signed by the company we're examining today. It's an absolute jaw-dropper of a figure, and it proves that the AI infrastructure wars are escalating to levels we've literally never seen before.
Welcome back to The Explainer. Today, we're diving straight into the mechanics of the AI boom, beyond just buying Nvidia stock. We're looking closely at the giant behind Nvidia, why Applied Digital is dominating the AI infrastructure market.
To really grasp what's happening here, we need to look at the current AI frenzy as a modern-day gold rush. We've all heard the old saying, right? During a gold rush, the surest way to get rich isn't to go panning for gold yourself, but to be the guy selling the picks and shovels, the concrete, the steel, the electricity. Well, Applied Digital is positioning itself as the premier company selling the absolute most critical picks and shovels to the market right now, which, in the AI world, means space, power, and cooling.
But here's the wild part. Applied Digital didn't start out as this AI darling. Flashback to 2021, and they were actually known as Applied Blockchain. They were effectively a crypto hosting business, renting out power and rack space to Bitcoin miners. But then the crypto winter hit. Hash prices totally collapsed, and their hosting margins just plummeted. They were faced with an existential crisis, so they made a hard pivot. They rebranded to Applied Digital in 2022 and made a massive strategic shift toward high-performance computing, or HPC, literally right before the AI wave crested. They managed to survive that brutal crypto crash by boldly doing what a lot of other companies just couldn't stomach. They actively wound down their crypto contracts, which, by the way, got them heavily criticized by crypto-native investors at the time. But they pushed through and entirely reoriented their physical assets to capture the skyrocketing demand for AI data centers.
And this right here was their absolute stroke of genius. It's all about what they did with those existing assets. They took these massive gigawatt-scale grid interconnections that used to run noisy Bitcoin miners, and they completely redesigned them to support the high-density, incredibly demanding physical specs of modern GPU clusters. In the data center world, securing a grid interconnection is hands down the hardest part. Applied Digital? They already had it. Now, what's really interesting about this next slide is the sheer scale of where that pivot has taken them today. 1.2 gigawatts. That is your total contracted critical IT load capacity. To put that into perspective, that is a staggering, mind-bending amount of utility power that is specifically dedicated to the most advanced AI training and inference workloads on the planet.
And obviously, all that power translates directly into massive revenue pipelines. They currently have $31 billion in base contracted lease revenue spread across 4 massive AI factory campuses. But wait, it actually gets better. If all the renewal options at each of these campuses are exercised, that pipeline swells to a breathtaking $73 billion. And we aren't just talking about abstract numbers on a spreadsheet here. In the physical world, creating this infrastructure requires an immense physical footprint, specifically for their Polaris Forge and Delta Forge campuses in North Dakota. We're talking about purpose-built AI factories spanning hundreds of acres, designed from the ground up to integrate high-density power delivery and highly advanced cooling architectures.
Which brings us perfectly to the crown jewel. This is the deal that recently shocked Wall Street, famously referred to in East Asian investment circles as the KRW $18 trillion AI data center jackpot, the Polaris Forge 3 mega deal. It's a 15-year take-or-pay lease with a massive US-based high-investment-grade hyperscaler. We are talking 300 megawatts of critical IT load. That guarantees $7.5 billion in base revenue, scaling all the way up to that staggering $18.2 billion figure we started this explainer with, assuming all options are utilized. Just look at the visual comparison here. The sheer magnitude of their transformation is honestly astounding. On one side, you have their legacy business, 286 megawatts of operating blockchain data centers. On the other side is their future, 1 full gigawatt of critical IT load currently under construction specifically for AI. It's a complete top-to-bottom metamorphosis of their entire business model. But listen, having all that power is only half the battle, right? Managing the heat is the other half. And that brings us to their real technological moat, direct-to-chip liquid cooling.
As hyperscalers pack more and more advanced GPUs into their clusters, think of Nvidia's notoriously power-hungry Blackwell chips, traditional air conditioning simply can't keep up with the heat. It just can't. Power and thermal management are rapidly becoming the single biggest bottlenecks in AI right now.
So, to stay ahead of this literal thermal wall, Applied Digital took a major strategic step. They led a $25 million investment in a Swiss developer called Corinthus. Now, Corinthus specializes in microfluidic direct-to-chip cold plates.
And let me tell you, this isn't just some minor tech upgrade. This specific technology gives them a massive competitive edge when deploying hyperscale infrastructure. We're talking up to 3 times lower chip temperatures than standard cold plates. This supports those ultra-high-density setups. It extends the life cycle of the cooling systems, even as hyperscalers swap in newer, hotter chips. And it does the whole shebang while significantly reducing fresh water consumption. It's highly sustainable and incredibly efficient.
Okay, so let's dive into the financials. We're going to look objectively at both the bull and the bear cases here. The bull case is brilliantly highlighted by their top-line explosion. Just look at this. Their revenue growth over the last 12 months sits at a phenomenal 105%. Demand for their services is absolutely surging as generative AI scales up globally.
However, we have to flip the coin and look at the harsh reality of scaling up this fast. Despite those surging revenues, Applied Digital is posting significant GAAP net losses because, let's be real, building out multi-gigawatt infrastructure is brutally expensive, and their cash burn is immense as they race against the clock to get these campuses online.
So we absolutely have to unpack the massive execution risks here. This is a highly leveraged, incredibly capital-intensive business model. Right now, their debt far exceeds their cash on hand. That creates a very real risk of shareholder dilution if they need to issue more stock just to raise the capital for construction. Plus, they suffer from extreme customer concentration. A huge chunk of their future relies on just a few key hyperscalers, including a massive bet on their partner, CoreWeave.
And because of that heavy leverage and high risk-reward profile, Applied Digital carries a beta of 5.69. For investors, that means the stock is roughly 469% more volatile than the broader market. It acts as a massive amplifier. If AI sentiment shifts up, it skyrockets. But if sentiment wobbles, say if Nvidia issues soft guidance, this stock can react violently. Drawdowns of 30 to 40% are considered totally normal here.
And of course, they aren't the only ones trying to solve the AI infrastructure puzzle. Let's weigh Applied Digital's approach against stiff competition, like Supermicro Computer. While Supermicro targets hardware-level integrated cooling, so optimizing the actual server rack itself, Applied Digital focuses on the campus-level macro infrastructure. It's essentially the difference between building a better engine and building the massive, specialized, high-speed highway that the engine drives on.
But let's be real, there are some absolute giants looming on the horizon. I mean, what happens if the biggest consumers of this tech, Microsoft, Google, Meta, simply decide to bypass third parties entirely? What if they vertically integrate and just build their own massive bespoke data centers? On the flip side, you have hardware innovators like Nvidia expanding directly into AI cloud services. Plus, there's the ever-present danger of construction delays. Any failure to quickly convert signed leases into actual operational facilities could be devastating.
So how are they managing those daunting execution risks? Through massive strategic partnerships. They've established an agreement with Macquarie Asset Management that provides up to $5 billion in capital commitments. That right there is the financial lifeline they need to unlock the billions required to build out their AI factory campuses, keeping them from drowning in their own ambition.
Which leaves us with one massive ultimate question. Will Applied Digital successfully navigate its heavy debt and execution risks to become the true foundational bedrock of the AI future? Or will the sheer weight of the capital required render them an over-leveraged casualty of the very infrastructure wars they are currently dominating? It's a high-stakes race, the picks and shovels have never been more expensive, and the outcome will shape the next decade of tech. Thanks for joining me on this explainer, and keep your eyes on the grid.